Okay, everyone, we are really about to get started here. So please bear with me. Little technical issue here on my side, but we are about to begin. Okay, everybody. Yep, starting the session with just a little delay. Technical issue, a little bit of a continuation of something that happened on Tuesday. Not expected and not welcome, but it's okay. Let's keep positive for a second because we're gonna start our session and we're gonna do what we're supposed to do, which is find a bunch of trades and plan them, explore them, and most importantly, execute them. Okay, so just bear with me, guys. I just want to make sure everybody's connected, so everybody is ready to get started. Okay, so. Okay, so let me see. Okay. Again, we are a minute and a half away from beginning our session, so just bear with me a little longer, and that's it. We are about really about to begin. Okay. Okay, everybody, we are now starting our session. Welcome to the get-together session with the AutoUFOs. Today we are talking about longer-term trading. So we're going to be looking at multiple opportunities, exploring the world of options, exploring other markets too, looking at directional, non-directional trading. Let's have fun, okay? Let's begin. Again, as always, when we start the session, we need to first go over the disclaimer. So today it's February 21st, 2019. My name is Jose Blasco and I will be your guide. And as I was saying, disclaimer, here we go. The following videos, clips, and demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive on using our products. Okay? Good. So we got our beginning slide of the session done, and we are now ready to jump into our trading platform. Okay? So here we go. We got TradeStation in front of us, and again, let's get efficient. Okay, we got 15 minutes before the market opens. My intention would be to identify multiple market opportunities. Of course, we will be adaptable. Okay, we as traders have the power to adapt to the market opportunities. We don't have the power to create market opportunities, though. That's reserved for the bigger players, the banks, the big corporations, etc. So what we're going to do is use a series of tools, including a scanner, to look for market opportunities, and then we will plan those opportunities using the AutoUFO app, where you can see here on the screen with the green flying saucers and the red flying saucers, and then we'll be able to execute those trades together. Okay, so we're going to explore different type of opportunities, and we're going to be ready to execute as I said, all of them. Okay, so the first thing I would like to show you, so we are on the same page, is the parameters of the scan I have just run right before the session started. So right before the session started, I went over to run this particular scan. You can see here the results. I got 15 symbols as a result of this scanning process. But basically, if you see the parameters that were selected in the scan, notice how everything have been checkmarked, but the row with the moving averages. Okay, so ignore the moving averages now. We will use that later, and I will explain the purpose of them. For now, ignore it. Okay, so we are looking at stocks above $50 per share. We are looking at stocks with at least 500,000 shares traded per day. So we are looking at relevant stocks with relevant volume. We are looking at stocks that have options with a minimum open interest for the options of 100,000 contracts. So we are talking about relevant stocks with relevant volume also traded in the derivatives, which in this case is going to be the options. And then the two parameters in the bottom are really the key in this first filtering process I just run here, which is the fact that we are looking for the options. We are looking for stocks with options. We are looking at the 25 stocks in the market, up to 25 stocks, the top 25 stocks in the market, with the highest level of implied volatility built in the options. Okay, in other words, we are looking at the priciest options in the market, because the first applications that we're gonna be looking at is gonna be non-directional trading. And if you recall prior sessions, I'm gonna give you an example before we start, so we are in the same page. But if you recall prior sessions, okay, non-directional trading means to sell options and then just wait for their expiration date, knowing that as time passes, the options value decays, and therefore you make money on time passing, as long as the stock remains in let's call it a range of prices, which is a reasonable range set by the UFOs, the green and the red UFOs. Okay, so we're gonna be looking at that, and of course, because I just said that non-directional trading would imply selling options. Okay, well, obviously we want the options to be the priciest as possible, so that way we can collect as much premium as possible, and that would be the way to end up with the most convenient trade. And when I say convenient, I refer to performance, efficiency, reward to risk ratio, etc. Okay, so we want hefty premium. Okay, that's what we want. And then also notice how the last parameter is also 25, or in this case is less or equal than 25, and we are looking at the ADX. In other words, when a stock has an ADX below 25, below or equal to 10 to the 5, so basically we could assume that stock is not really in a trending mode. So the stock may be moving up or down, but without a strong momentum, and therefore if the stock does not have that much momentum, so basically what that means is that both the buy and sell orders should be respected, and therefore that stock will react to the green and bounces like it did, or react to the red and bounces like it's likely to do, and therefore for a while stay in a range, which is exactly the setup we're looking for when we are planning to do non-directional trading. We want the stock to stay in a range or not to move too far from the current price. So thanks to the filtering process, we saved a lot of time. Instead of looking at 9,000 stocks one at a time, which is more or less the amount of available stocks in the US market, we basically run the scan and we ended up with this list of 15 stocks. Okay, so again, very concept to find those options with the priciest premium, but let me open here a series of websites. Okay, and the most important website I'm going to launch now is briefing.com. It doesn't need to be briefing.com. It could be many other websites, but the beauty with briefing.com is that it's a website that will give us information related to earning reports. And well, this is important because if the options that we're going to sell are very highly priced, and the reason why they are very highly priced is because, let's say you have an earnings report in front of you, well then, with the earnings reports, typically stocks will gap up or down, which is the opposite of what I said we are looking for. We are looking for stocks that would be likely to remain in a range of price that is, let's call it narrow. So if having earnings reports in front of us, yes, may impact the price of the options, and that's why those stocks show up in the 25 list. Okay, in this case it was 15. We took the top 25 stocks that meet our conditions. So that's good. There is a lot of premium built in those options. Fantastic, but if the premium is built in the option for the wrong reason, which is the stock is likely to gap strong on earnings, then we have an issue. So what we're going to have to do, we're looking for anomalies. Okay, anomalies equal edge. Okay, so if I look at Amgen, for example, which is one of the stocks on the list, where you can see that the earnings report is likely going to happen on April 24, which happens to be April 24. Well, that's going to happen much further in time. Okay, much further in time. That's all the way in April. Is a long time away from current date. And notice that the prior report took place on January 29, which is already like 3 months ago. Sorry, 3 weeks ago. In other words, there seemed to be no apparent reason for that stock to have such a level of premium. Maybe there is another reason happening out there where maybe there is a company merger, things like that. That could be the reason, and it would be certainly healthy to do some research. But at least from a purely technical point of view, it doesn't look like there is anything important, relevant, that statistically could be a problem that is increasing the price of the options, and therefore planning a trade on Amgen could be a good idea. Okay, so what I'm going to do is I'm just going to make a list in the bottom part of my radar screen. Okay, I'm just going to make a list of a few stocks that could be good candidates for us to try to plan non-directional trades. Okay, so I just type Amgen here to do the list. And I'm going to do this very quickly. I'm just going to go for one symbol at a time. If I look at Baidu, okay, so Baidu is reporting on the 21st. Oh, by the way, that's today, so forget about it. What else? BMY, Bristol Myers. BMY will be reporting on April 25, and the reported earnings on the 24th of January. So similar setup or similar situation compared to Amgen. So I'm just going to type Bristol Myers here on my radar screen. So then I'll come back to check the chart manually. What else do we have? I have BUD, and I'm going over this process in front of you guys. So, the days that we are not getting together, you can actually run this process yourself. Okay, that's why I'm doing it in front of you, so you can then mimic what I'm doing for yourself. Okay, so the next earnings report is on the 28th, which is Thursday. Okay, and we are not going to call this valid for us because expiration dates are on Fridays. So we want options that expire after Fridays, okay? And in this case, the 28th is Thursday. So with the basic application of options trading, we will just ignore that opportunity. We will get more advanced at some point, and we will be able to see cases where we could actually find a way to make it work. Costco, as you just saw, provides expiration dates located on March 7. So we got like 2-3 weeks from now. So it could be a candidate. CRM. So let's take a look at CRM, company Salesforce. So we're looking at CRM, that's March 4. So CRM could be a candidate. This, when I say could be a candidate, in the end, what I'm saying is that depending on those UFOs, okay, we'll be able to see if it's a candidate or not. The next one, it would be EA, Electronics Arts. So I'm just loading Electronics Arts. May 7, the earnings reports took place on the 5. So EA could be a candidate as well with certain level of premium. EOG, and that one is going to be 26. Okay, so 26 would not work, as we said. We want Friday or beyond. First Solar, FSLR. Let's take a look at First Solar, and we're going to end up with at least, maybe 6-7 symbols, and then we will analyze this manually. So First Solar is today, 21st of February, so we ignore First Solar. Lilly, LLY. So LLY is April 30. The prior expiration, the prior report was on the 6th of February. So LLY could be the reason. Okay, so LLY could be a candidate. I meant. So we're gonna see that low LOW, we'll have a few more symbols and that's it. Low is on 27. 27 doesn't work. 29. We said 28 was Thursday, and I was saying 29. Of course, we don't have 29 in February. So 1st of March would be the next Friday, and 27th of February is before that. So we ignore low. Then we got Qualcomm, QCOM. So Qualcomm is May 1st, okay, where the prior earnings were on the 30th of January. So Qualcomm could be a candidate as well for non-directional trading. And we got two more to go. We got SQ, okay, SQ, which is the 27th, so it doesn't work. And then we have Target, TGT. TFT, sorry, TGT. Oop, hot finger. Okay, here we go. So TGT would be Target, and Target is showing us March 5, which obviously we could take that, okay? So we have, those are the symbols that we ended up with, okay? And just to be visual, so for the traders that you are joining us today and you have never done non-directional trading before, so I want to show you, for example, SQ, which by the way, SQ, you can see it on row 13 down here, which is a stock symbol that our scanner is telling us that potentially could be a candidate, even though the earnings reports are happening too soon, where SQ was a candidate maybe 1 or 2 weeks ago when we planned this trade for non-directional trading, where, you know, we took the trade the day with the circle, we identified red UFOs where the blue line is, green UFOs where the bottom blue line is, and our expectation was that that particular stock was going to stay in this range from the vertical line on the left to the vertical line on the right, which was the day when the options expired. That was February 15. So what happened, we did what is known as an iron condor, which basically is a strategy where you end up selling options. And we just waited until February 15. And because on February 15, we didn't surpass the upper blue line, we didn't surpass the bottom blue line either. So those options expired, and therefore all the premium collected on the entry date, that was February 7, all the premium collected was kept by the trader. And I know some of you were in this trade, and therefore I'm gonna have to say congratulations to you. Good job. Okay. So the idea is to look for similar setup, knowing that, of course, it's all about probabilities. So hopefully we'll find many setups when where this happens, and you make money in a very relaxed fashion. This is amazing for busy traders, if you wish, okay, people that are busy, they have a busy life, you know, so it's very nice, you know, you do these trades and you just let time pass. You don't need to be glued to the computer screen to make some money from the markets, okay? You just make money on time passing, which is quite an efficient way on how to make money, okay? But of course, even though it's an efficient concept, not every single trade will profit, okay? So we will look at different scenarios. Let me find another example. Let me close this window. We will look at other trades that we have running. So for example, HD, okay? So if I look at HD, okay, well, HD probably also ended up as a profitable trade, okay, because we also use an iron condor with February 15 expiration. February 15 is right here where the vertical line is. And notice what happened here, okay? We surpassed the blue line just by a little bit on the last day of the trade. Okay, so we were expecting this to remain sideways. Actually, this market started picking up momentum and direction. We ended up reaching that place on the chart where the price was not likely to reach this place on the chart, but it did. So this trade actually would have ended up as a theoretical loss, even though I am pretty positive, and please, if you have been executing this trade in your account, it would be nice if you could report on the comments box, okay? So I know. But basically, if you had been in this trade, I'm pretty positive you would have concluded this trade for a small profit, nothing magic, but a small profit. Even though the trade didn't behave the way as expected, it didn't stay in the yellow box between the horizontal and vertical lines. It surpassed the yellow box by a little bit. Well, well, it surpassed it by a little bit, but remember, you collected all of this time of time decay, and therefore, I am telling you that this trade ended up as a profit, even though it was a smaller profit than expected, but it was still a profit, even though we were wrong. So it's pretty nice, okay? So if the same thing had happened, but instead of taking from the day of the entry, which is January 31st, if it hadn't taken that long, if the market started picking a lot of momentum sooner and you had reached the upper part of this blue line sooner, then you would have ended up with a size of a loss that would be the, let's call it the expected loss. But because it took so much time, well, time passing, eroding the price of the options is called time decay, which is a common concept, very well known and appreciated by options traders around the world. Well, then this trade would have ended up as a small profit, as I said. Okay, so anyway, now that I kind of refresh what is non-directional trading, and we know that we have 1, 2, 3, 4, 5, 6, 7, 8 symbols here for us to analyze, 8 potential market opportunities. I'll start from the bottom to the top just to pick one. So we're gonna look at the charts. We're gonna look at our AutoUFOs. We're gonna plan the trades and see if the market is bringing us an actionable market opportunity that could make sense. Okay, so what do I need to do? Well, I'm gonna have to load the chart. I want to move that chart lower to uncover where the red UFOs are, to uncover where the green UFOs are, because remember, for me to expect this thing to remain range bound, it means that I need to have red UFOs above and I need to have green UFOs below. So when it comes to the green UFO, I'm expecting it to bounce and therefore consume time. When it goes to the red UFO, I'm expecting it to bounce and move down again and therefore consume more time, and all that time is time decay. Another way to say that is all that time is profit. Okay, so I need to move my chart in order to uncover all those different UFOs. The other thing I need to do is I need to load my Option Station Pro to be able to access the prices of the options that are available now real time. The market opened 3 minutes ago. And because the market opened 3 minutes ago, so the options quotes are probably flashing on the computer screen. And therefore, we're going to be able to see the price of those options. Okay. By the way, while this is loading, which is taking a little longer than normal. Okay, now it's loading. Okay, it's loading on my other computer screen, so I'm going to move it to the main screen that I'm sharing in just a sec. But just keep this in mind. I know that some of you with us today have traded options for years in your life, and you are amazing experts in the world of options trading, okay, and therefore the initial explanation of the day is quite of a slow-paced type of explanation for you. I also know that some of you in the room have never ever traded options before, and therefore options may feel a little overwhelming. Okay, so I would like to ask everybody to bear with me, okay, to relax, because remember, if you look at the schedule of get-together sessions, okay, hopefully everybody is very well with the get-together sessions. You know that every Sunday session, so let me show you the calendar just in case very quick. So every Sunday we do sharpening. The next sharpening session will be 2 days and 23 hours from now. That's Sunday, February 24. And on those sharpening sessions, that's when we spend time as the markets are closed to go over, let's call it the theory of trading. Okay, so what I'm trying to say is that if you are not fully familiar with options, just give me time. And believe me, guys, I'm going to be helping you massively on understanding how options work. And then you take 5, 10 trades, and then next thing you know, options that to some of you now are a stranger to some of you, next thing you know, after 10, 20 trades, 5 trades, 25 trades, whatever, depending on how you learn, because everybody learns differently. So next thing you know, options that were a stranger to you are not a stranger anymore. Okay, but please bear with me, even though to some of you options may be a stranger, because that way when we do sharpening together, some of the things I will be explaining with great amount of detail, well, they will happen to not to be the first time you see them. Okay, where if you were to kind of spend this get-together session texting on your phone instead of watching closely what I'm about to do, well, then when we do the sharpening, it would be more abstract, if you wish, because you got the theory, but you haven't seen the practice. Okay, so we got a little bit of the egg and the chicken. If I show you the practice first and then the explanation clicks, but the practice overwhelms. If I give you the explanation first and then the practice, then the explanation clicks, but then the practice overwhelms. So it's kind of, everybody's different. So just bear with me. That's it. Okay, if that's okay for me to ask. Okay, so now if I measure from current price the distance to where the red UFOs are, and I was to copy this line and I was to project it to the downside, okay, so basically what I would be saying is that based on those UFOs, I would not be expecting the price to surpass the blue line above anytime soon, and purely based on this mathematical projection, I will not expect that market to surpass the bottom line, which really 65.85 makes no sense because there is no UFO there. 67.20 would make much more sense because there are UFOs there. So that would be a much better place where to expect that market to not to go. Okay, so that would be a place where you don't expect target to reach this area on the chart anytime soon. That's basically what I'm trying to say. Now, in the meantime, before I am too strong on this opinion, I want to go ahead and check on my pre and post market data, because we talked about this before. Sometimes stocks have very relevant quantities of on-field orders that are placed in the market pre and post market, and other stocks don't behave this way. So the way we're going to know how this stock is traded by the big players is by looking at that percentage number. If 51.84 is what we got for regular session, if I switch to pre-market and post-market, okay, if I switch to pre-market and post-market, and this number is greater, which is the case, okay, and this number is greater, which is the case, well, now I know that the pre and post-market data is relevant information. And by looking at the pre and the post-market data, well, notice that I still see my red UFOs above. I still see UFOs below price, okay? And the bottom line, the one that is all the way in the bottom part, still makes no sense because I still have no green UFOs down there. So what I'm going to do is, when it comes to defining what I'm expecting that stock to do, okay, when it comes to defining how far I expect the stock to move from now until the expiration date of the options, I'm going to say that the boundaries of the range that I am defining with target would be set from 79 to 67. So the question is, if I sell the 79 options, okay, if I sell the 79 options with next week, for example, how much I get paid? Okay, and next week the 79 options pay you 3 cents. Okay, which means that it's not only we don't believe the stock is going to reach that place on the chart anytime soon, no one believes it. Okay, and because no one believes it, the price of those options are so low. Remember, Target has a earnings report happening on March 5. Okay, March 5. So March 8. Okay, you can see it here with the implied volatility number. Notice how from 23 we got double. From 23 we got 42. Let's call it double. We got double the expectation for price movement from price movement on March 8. Why is that? Well, because the earnings report is priced in. What's the problem? March 8, which is Friday, happens after March 5. Okay, so even though it seems that we could use March 1st, the problem is that the place on the chart where the UFOs are too far from where the current price is, and therefore the premium we would collect are not enough, even though Target has a great amount of premium built in based on the scanning process that we have done. So I'm just gonna get rid of Target and focus on Qualcomm and take a look at if Qualcomm provides a trade. Okay, and now that I spend time to do this process slowly, I'm just gonna rush it a little bit. Okay, so I'm gonna do this very quickly in this process, just so we have more time for more trades as well, and you can always go back and watch the recording after the session is over, just in case I went a little too fast. Okay, so again, with Qualcomm, we're dealing with expiration all the way on March 1st. So if I look at on May 1st, Let me double check that. I want to not make no mistakes. Yes, May 1st. So May 1st, okay, here we go. Okay, for whatever reason, it didn't load well. So let me close Option Station Pro and let me launch it again. So I'm gonna launch Option Station Pro one more time. So we're gonna look at the May 1st expiration, actually the expiration prior to May 1st. That's the expiration we're gonna check and see how much those premiums are. While Option Station Pro is loading, I'm gonna go ahead and use my horizontal lines to draw different possibilities on my chart. Well, one possibility I would love is, to have an expectation for price movement on Qualcomm where we are not likely to surpass 56, okay, anytime soon. Why? Because, well, I got a UFO, another UFO, another UFO, another UFO, another UFO. Well, that's a lot of UFOs. That's a lot of on-field orders, and therefore, could you go above 55.91? Yes, of course, but normally we take a great amount of time. So if the options available on Qualcomm were to provide a great amount of premium, I would be delighted to do some sort of planning, okay, to sell 56 options, okay? Well, March 1st does not offer anything interesting. 56 on March 8 offers very little premium still. If we look at March 15, now, of course, more time, more premium. So now we're going to have a little more. Now we're having 19 cents. It's okay. It's not amazing. Okay. So I could certainly go for the next one and the next one, as long as I don't surpass May 1st. So I could go up to April 18. Okay, I could go that far if I choose to. Now, I would like to find an optimal setup. And therefore, what I also want to look at is the percentages that I see here with the implied volatility. Okay, 27 would be better, but we don't have premium enough. 25, 26, then we drop to 23. So March 15 was not providing enough premium. If we do March 22nd, that may provide enough premium, but it gives me 23 volatility, where March 29 is giving us 26% volatility, which is kind of like the greatest figure here. So let's take a look at March 29. If we got March 29, well, now we got 25 cents, okay? And the only problem here is that we got a little bit of a larger spread because it's a quarterly option, and normally quarterly options are less liquid. So I'm gonna go back to March 22nd, even though I was liking better the 26, but notice the difference in liquidity here, 28 to 31. That's a nice liquidity. Okay, that's a nice liquidity. So let's take a look. Let's take a look. For now, I'm just going to be thinking of that option. Okay, and what I'm going to do now that I know that I have some premium, I'm not going to say it's super amazing, but I have some premium. So now let's assess the put side by projecting with that vertical line, projecting from current price, a horizontal line, and see what happened. Okay, and I'm gonna go. It's kind of like you are engineering the trade, and then you are gonna be reverse engineering the trade. You'll see what I mean by that. Okay, so we are pointing at 48.58. Okay, again, before I get too excited with 48.58, 58.51% is the data for regular session. Let's take a look at pre and post market. If the number is less, we will ignore. If the market is more, we will consider it. If the number is less, so we will ignore pre and post market. So going back to regular. Okay, going back to regular session. Okay, and basically what we have is that the top part is telling you that the market is not supposed to go anywhere further than that direction, but below is looking like, it would not make no sense to have the line further down below 49.56 because there is nothing to stop price from keep falling below 49.56. There is no green UFOs below. So if I was to define a range, okay, so really the range, the most logical range would be a range between 55.91, let's call it 56, and 49.50, let's call it 49. And if you were to do that, well, now here we go, we got the 49. Okay, now you don't want the 49, you want the 49.5, but this doesn't exist. So maybe we end up combining 49 and 50 all together. Okay, and we end up producing that. Okay, so let's go ahead and write it down on the screen, so you guys can follow this explanation and see if we find a good setup to make this work. So I would begin this trade by buying. Okay, so I'm just going to type buying, okay, or buy the 57 call. Okay, then we're going to be selling the 56 call. That's the key. That's the one that pays you. Selling the 56 call. That's the option you sell. That's the option that pays you. When you sell, you get paid. So you collect the premium and you wait for the option to expire. That's the one that pays you. In case the market was to move up very aggressively, the 57 call is going to be like your stop. It's going to be like your protection. It's like you sell insurance and you buy reinsurance to protect the insurance you sold. Okay, so those two trades kind of offset each other. Okay, so you are kind of hedging your trade in case you are wrong to protect your risk further. Now below, what I would like to do, if I could do what's above, okay, what I would love to do is to sell the 49.5 put, okay, and then buy below the 48.5 put. Okay, I'm writing it for it to be visual for you, but remember, if I look at the option chain, there is no 49.5, so I could not do that. Okay, I could not do that. So what am I going to have to do here? Well, I'm going to have to be a little more creative. And if I want to simulate the 49.5, so I'm going to have to kind of maybe sell one of the 50 and sell one of the 49. If I sell one of each, it's kind of I sold two of the 49.5. So then I'm going to have to buy two of the protection. Okay, and for now, I'm going to call it 48, and we'll take a look at that later. So if I do one of the 50, one of the 49, this is like I'm selling I'm selling two of the 49.5, and therefore I buy two for protection. Now if I do two below, then I'm going to have to do two above. Okay, just to be properly balanced. Okay, so this is a little bit of a complex type of options approach. Okay, for the traders with us today that you have not traded options before, this is probably getting you thinking. This is probably close to overwhelming, but please, just bear with me, follow me, because this will make sense, and especially as you see these things happen, and then you join us on the Sunday sessions when we do sharpening, we will get to a point where you will understand that. And for the traders that you are more advanced, of course, you know what I'm doing. Okay, so we're gonna be dealing with that. Okay, so expiration date, I believe we said March 22nd. Yeah, so that's gonna be the expiration date. Okay, so we're gonna write it here. Expiration date. So we'll do March 22nd. Okay, so that would be the plan for this trade. Okay, so let's go ahead now and insert this trade in our computer screen so we can simulate this more properly. Okay, so the way I'm going to do it, okay, is I am going to I'm going to analyze and sell what is known as an iron condor. Okay, but then I need an extra option to be sold. Okay, so you know what, just to be a little more visual, let me do this, just to be a little more visual, especially for the traders that you have not seen this type of combination before. So let's do it manually. So I'm just gonna simulate and buy the 57. I'm going to simulate and sell the 56. So analyze, sell 56. Remember, we're doing two. So 2 and 2. And to make it more visual, what I'm going to do is I'm just going to put them together. Here we go. So, okay, buy, sell, 2. So selling the 56 and buying the 57. Okay, so if you notice what I just done, I did it manually, and if I did it too fast, again, you can always watch the recording and play and pause. But basically what I'm doing is I'm selling the 56 call, right, and then I'm buying the 57 call, and I'm doing 2 units of each. -2 is for sell, +2 is for buy, and I'm doing 2 units because that's what I said. Sell 2 of the 56, buy 2 of the 57. So I'm kind of replicating what I had on the screen written on my options analytics tool. And now I'm going to do the bottom side, which is going to be sell 1 of the 50, okay, and sell 1 of the 49 and buy the 48, right? And when I do this, it's kind of like a mess all together here. But if I start again, click and hold and drag it, and I start merging those legs, okay? We call in options trading, we use the term legs, okay? So if I keep merging those legs, and now I put the put side together, which is 3 units, right? So what do we have here? Well, let me go ahead and organize it better. So I would have buy, I did the opposite. Here we go. Good. So we're going to buy the 48 below, and then we're going to sell the 49 above, and above the 49, we're going to sell the 50. Okay, so I'm going from top to bottom, if you wish, 57, 56, 50, 49, 48. And if you look at it, we got -1, -1 plus 2. Well, what I just put in here in my trading platform is exactly the same thing that you could see on the computer screen. Okay, 50, 49, and 2 of the 48 below, 2 of the 56 above, and 2 of the 57 above. Okay, so that's exactly what I have. Okay. Now, if I was to do this the way I have it, okay, notice that the bottom part, the put side, would pay me 35, the call side would pay me 5. So altogether, this trade would pay me 40 cents per contract times 100. So that would be $40 per contract. Now, this is if you go for market price. If you go for the midpoint, you would have 55 and 10. So that is $65 per contract. And if you do 10, this is $650, okay? That you're going to make in this trade if we are accurate on how the trade works. But again, what I want to assess to make sure that the trade makes sense is what if I'm wrong? Okay, because of course if I'm right, okay, that's great. We know how much we're going to make, isn't it? But what if I'm wrong? Okay, so I would like to go ahead and with those red dots, okay, above and below, I am basically representing the top part, the bottom part, what if you're right, what if you're wrong, and in the middle, I'm going to use the last price because 52.10 is the current price of that stock. And we said that the current price of the stock is 52.11 now. We don't expect it to reach 55.91. So 55.91, we don't expect it to reach that price, okay, 55.91. If we reach the bottom part is 49.56, so 49.56, okay? So how much is that? Okay, so we got it here. So last price, current price, in the middle, where it's 52.09 right now. We don't expect it to reach above 55.91. We don't expect it to reach below 59.56, right? And so what if it happens? Okay, what if it does? Well, if it does, notice how the upper part, it's losing $42 for us if that was to happen today, where the bottom part would be losing $75 for us if it was to happen today. So notice how the bottom part is unbalanced, and you can see it on the graph too, where this horizontal line is much lower compared to this horizontal line. So the lower part of this trade is penalized compared to the upper part. So I'm going to move my 57 to 58. This is called an adjustment. I'm doing an adjustment to see what happened. And if I do that, well, it's looking much better now. Okay, it's looking much, much better now, because what would happen now is that if you were to be right on this trade, okay, you would collect, I'm going to use the midpoints now, you would collect 57, okay, plus 17. That's the maximum you would collect. That's $74. So you would collect a maximum of $74. And if the trade was to move against you all the way, meaning today in one shot you reach the upper blue line or the bottom blue line, well, then, you know, you would lose either 82 above or 63 below. So we're talking about kind of like a one-to-one type of trade, which to some of you may be enough, to some of you may not be enough. But remember, what's the beauty here? The beauty here is that tomorrow we got theta kicking in. Theta, don't be intimidated by those words either. Theta starts with T, T is for time, so time is time decay. So what does that mean? It means that if you get stopped out tomorrow, is 87 cents less per contract, 54 cents less per contract. So what happens that, you know, after a while, the speed of time decay accelerates as you approach expiration date. And really, let's face it, you know, when you look at the huge amount of distance to both stopping points, and the fact that we got multiple green UFOs between each other. So the probability of you being stopped out in 1 day or even 1 week, I would say, is basically none. Later, when we get to spend time with sharpening sessions, we will actually run analytics to a deeper place. You will see me open this window here and start playing with dates and so on in order to really assess how much would you lose if you were to be stopped out in certain particular dates. And you will be able to assess the risk of the trade even more precisely. But for now, it's looking like this trade would be valid to be executed. So we found trade number 1 of the day. And if you guys have never traded options before, so I would say just take this trade in a paper money account so you can watch it from the sidelines, learn from the experience, but it's not real money because you obviously you need to be efficient and proficient with options trading before you execute trades with real money. But if you are an options trader who is more advanced, then you know exactly what I'm talking and you know how to execute the trade. So go ahead and, the risk appetite, you define that, okay? So trade number 1, okay, it's Qualcomm. And I'm just going to make a copy of this chart, okay, so we can keep this trade here for future reference. We'll be able to learn from it. Okay, we'll be able to learn from it. I'm just going to keep that window minimized somewhere on the chart where it doesn't bother us. Remember, we are shooting for 22nd of March. Okay, so that's the amount of time we are planning to be in this trade as a maximum. Okay, so that's what we're shooting for. And what I'm going to do now with that chart is just minimize it. Okay, we're just going to minimize it, and we'll take a look at that. Okay, because later in time as well, we'll be learning how to do adjustments and how to do certain things in case Qualcomm starts picking up direction, and instead of a non-directional stock, it becomes a directional stock, and so there are certain things that we may need to be doing, okay, to manage our trade and manage our risk. Okay, but for now, easy. Sell this interesting variation of an iron condor and wait for time to pass until March 22nd. Okay, so anyway, so this was trade number 1 for the day. I will not be looking at other non-directional opportunities because of lack of time, but I went over the process on how it's done, and I did it once for Qualcomm. So feel free to replicate the process yourself. And if you were to have any question, you can certainly send us an email using reach at tradewithufos.com. Okay, and I'm just gonna have this on the main screen, just in case you are not familiar with our email address. Okay, so you get it, and that way you can be communicating with us easily. Okay, now scenario number 2, I would like to also plan on a directional trade, and we are 1 minute away from the theoretical time where we should be concluding our session. We started with some delay today, so if that's okay, I will look for 1 trade for directional purposes, and then we'll call it a day. Okay, so what are we going to do now? Well, now notice how I'm going to change some of the parameters of the scanner. The first thing I want is I want stocks with an ADX greater than 25. In other words, I want stocks that carry certain level of momentum. I want stocks that are clearly moving in some direction, and therefore likely to continue based on stats. Okay, so I want that. Then instead of looking at very pricey options, I want the cheapest in the market, because now for directional trading purposes, what you're trying to do is to catch a move and ride the move, and therefore you don't want the expensive options to be sold. You want the cheap options to be bought. So we are kind of going to do the complete opposite of what we have done before. And now, on top of that, I am going to activate my moving averages row, okay, where what I'm saying now is I want the 21 moving average to be above than the 34 moving average. In other words, what I'm looking for if I do this is I'm looking stocks in an uptrend. And by the way, this is exactly the same thing I did in the prior session last week. So just to give you a little diversity so you can replicate all those things yourself, what I'm going to look for today is stocks in a downtrend, okay, just to look for different setups, different scenarios. So that way you can learn more and better, and then you can replicate all those things yourself, because you could be taking a screenshot of this scanner right now and replicate it yourself, or simply, watch it recorded again, and then you can pause and all of that, okay? So I'm going to run the scan. The moment I click run, it's going to take a few minutes here to process the information, okay? Just wait for it for a second, guys. I'll take a sip of water. I'll be back in just a sec. So the scanning process is running. Okay, you will see those 0% to move up in just a second. We already did the first beginning parts of the scanner. The two steps above are the fastest, and the reason why they are the fastest is because those steps happen to run within TradeStation servers. So TradeStation is doing the filtering for us in their servers, so it's very fast. Where the 3 steps below, these steps imply, number 1, downloading the relevant information for that process to be able to be calculated locally on your computer. So first, you need to wait for the market data to be downloaded, and second, then you have an intense computing process happening on your computer locally, and therefore it takes more time. Okay, and also when you see me executing this while I am connected with you, sharing my screen, the process is way slower compared to if I do it without sharing my screen, because obviously sharing the screen at this moment in time as we speak, we are broadcasting this training session via iZone, via YouTube, and also via Facebook, and all of this is consuming computer power of my machine. And just to give you a little technical explanation for you to understand that if you do this on your own, it's actually way faster. But if you are, watching YouTube videos at the same time or stuff, you may experience, less speed on that execution, because this is intense for your computer. Okay, you guys need to know that. Okay, so my recommendation is to run those scans, okay, with less stuff running on your computer, so you are doing it faster. Okay, in my case, I cannot stop. I cannot change that, because obviously it would make no sense for me to stop broadcasting while we wait for the scanning process to be completed. Okay, so anyway, so let's wait. It's going to happen very quickly. Okay, but while we wait, let me give you an example of what I'm about to do. Last week, we were looking at Expedia. Okay, so this is Expedia, and I'm going to activate the UFOs here for Expedia. And if you were in the session last week, you probably remember that we identified those 2 UFOs overlapping each other, and we did plan a trade entering long at 120.86. That was a few days ago. Expedia was falling. Actually, it felt, aggressively, but then it never got to 120 and started bouncing and stuff. So, we'll see if this trade in the end is a trade that meets entry or not. But basically, the way we plan this trade is the same process that we're going to do now, looking for new market opportunities, kind of the same process. The only thing is that last week, when I did the scanning, I was looking at markets in an uptrend, so looking to buy, and therefore, as it's written here on the bottom part, I was using calls instead of shares of stock. So instead of purchasing shares long, I was purchasing calls, which is equivalent to being long. And if you have been watching our sharpening sessions, you know what I'm talking about. Okay, so we were doing that last week with Expedia. Okay, and we were planning to buy the April 18 expiration date and buy the 120 call if Expedia reaches 126, which didn't happen at the time. We were expecting, thanks to the simulation, that the price of that 120 call would be $560 per contract if and when that happens. Okay, that's what we expected. So today we're going to take the same concept and we're going to reverse it. Instead of looking for stocks in an uptrend and try to join the uptrend by buying when that stock drops into a green UFO, okay? Instead of doing that, what we're gonna do is reverse it and look for stocks in a downtrend and be ready to buy puts instead of buying calls, we will be buying puts instead of shorting shares of stocks. So we're going to be betting on a move to the downside, ready to profit from a move going down, and we're going to do it via buying puts. The key, of course, is the timing. Calls and puts options are great, but if you take the trade at the wrong time, you get in trouble. Okay, you get in trouble. Therefore, the idea is to use the AutoUFOs to be able to time the trade. So we got one market meeting those conditions is AGN. Only one stock is meeting all those conditions as we speak. Okay, so interesting. Okay, interesting. I'm going to move to a daily time frame to do this application because the scanner was running in a daily time frame. So let's move to daily. Here we go. And here you can see how that particular stock is in a downtrend, okay? And we have a red UFO pretty close by, okay? So the opening price is 140, the closing price is 138.16. So actually that stock opened where the red UFO is. That's where the stock opened, and from there is falling, okay? So bad news, okay? It seems that we are kind of missing the trade, but you know what? Not necessarily. I'm still going to plan this trade, and here's why. Because that stock is falling, but notice how we never reached the inner circle in the flying saucer, which represents the area on the chart where we potentially have the greatest concentration of on-field orders to sell. So in other words, if this stock was to go back up, you can still take the trade because most of the on-field orders we're expecting in the red UFO is still there. Okay, so you can still take the trade. And now, why am I expecting the stock to go back up? Since the stock already started moving down. Well, I'm expecting it to go back up because what do we have here? We have a green UFO, and the green UFO is likely to bring the prices back up, okay? So could be wrong, and the market keeps falling down, and if that's the case, then we did miss the trade. But we have 55% probability that it will bounce, go back up, and by the way, I would say we have more than this probability, because if you think about the amount of white space between the two UFOs, yeah, they're so close to each other that just a little tiny bounce from the green UFO would do the job. Okay, so in this case, you know, this is something for you to watch for later today or even tomorrow, and this trade may very likely be about to happen. Okay, so what are we going to do here? Well, the idea would be to buy puts instead of shorting shares of AGN. Okay, so instead of shorting Allergan itself, we want to execute the trade via buying puts. Buying puts is equivalent to shorting in the sense that you make money as the markets fall. Many more benefits of buying puts than shorting, but we'll talk about that in sharpening. Okay, so which put am I going to buy? Well, that's when you load the option chain for AGN, and we can look at what's available. Okay, now something we need to know about AGN before we even start is that AGN, it's probably not the most liquid stock in the world. Okay, and I'm just saying that out of my experience. If you didn't have the experience, you just need to look at the column with open interest, and you will see. So if I look at, for example, March 8, okay, you can see is a few dozens of contracts. Okay, a few dozens of contracts. If you look at the March expression, which is the monthly expression, now we got thousands. Okay, so notice how there is a massive difference between the open interest in what we call the monthly expression date compared to the weekly expression date. And this is typically the sign of stocks that are less liquid, that have options which are less liquid. The current price for Allergan is $138. So if you look at what is known as the at-the-money option, the at-the-money option got a spread from $435 to $390. That's 45 cents of spread. Again, this is another sign that tells you those options are not the most liquid in the world. Okay, so we'll talk about shaving. Shaving means that when you buy an option, you don't pay market price. Okay, because if you pay market price, you will be buying at 435. So you're going to have to do aggressive shaving. Okay, you're going to have to do aggressive shaving if you do this trade. Okay, So I'm going to talk about that in just a second, because if not, you will be hurt on lack of liquidity, because Allergan is okay, but it's certainly not amazing when it comes to liquidity. We cannot change that though. So we're going to have to play it smart. And then the next question is, okay, out of all those expiration dates, which one I'm going to use? Well, I already give you a tip that instead of using the weeklies for that stock, I'm going to focus on the monthlies because of liquidity. But also, I want to make sure there is an excuse for that options to gain value. And therefore, I would like to look at when is the next expiration date, okay, which is April 29. April 29 is the next expiration date. And therefore, I would like to buy an expiration date that somehow got the pricing of the earnings report built in. Why? Because that way, if the stock doesn't move much against me and time passing is eroding the value of the option, well, at least the fact that earnings reports are approaching will increase the premium built in the option and kind of offset the time decay problem that always happens when you buy options. Okay, options decay when you buy them, so that's bad. So I'm going to look at April expiration. You can also use May. Technically, you should use May because April 28 is up after April 18, so you should use May. But I'm pretty positive. If I look at April, you have, let's say I look at the 140, so 15 to 60 is 55. You mean 55, where 40 to 95, actually I got $55 of spread no matter if I use April or May. So I rather use May in this case because I have the same pain, if you wish, on slippage. Okay, the difference between the bid and the ask, we call that slippage or spread. I got the same pain on spread, but then I will get a lesser time decay effect because something you need to know about options, okay? And we will talk about that in the sharpening sessions again, but just for you to keep in mind that the longer the time to expiration, the less the time decay will hurt you, right? So we're gonna go with May, so you got less pain on time decay while you have the same amount of pain on slippage. And then we're gonna have to shave that, so when you buy the option, instead of bidding 760, you may bid 740 or something like that, and try to get in the middle of those two prices to not to be badly hurt. Okay, so this is what we're gonna do, and therefore we are proposing to buy, okay, buy a put, okay. I'll write it here. So buy a put, and I'll come back to define which one. It's gonna be the May 19 expiration put. Okay, it's probably going to be the 140 or something like that, but I'll come back to this in a minute. So buy the May 19 140 put if AGN reaches the red UFO located at, so let me go ahead and click on the box. The box goes from 140.17 to 146. So 140.17, that would be our interest, correct? So 140.17. So we're gonna buy the 140 put, and by the way, I now confirm it's gonna be the 140. Why? Because this is the price of the UFO, so we are making sure the UFO and the option is the same strike or the nearest one. You would love it if it was the 140.17, but when you look at the option chain, the 140.17 does not exist, but the 140 does. Okay, so we're going to use the nearest, which is 140. So we're going to buy the May expiration 140 put if AGN reaches the red UFO. And from there, two things may happen. If it goes up, now you start losing money. But the most you will lose is what you pay for the put. Okay, how much would that be? Well, if I buy the 140 put, okay, and I was to simulate 140.17, right? So 140.17 okay, would give you a value of 785.25. So we are expecting the value of the option, the current value of the option is 858, but we are not buying the put now. We are buying the put only if, remember the if, only if AGN reaches the red UFO at 140.17. So if it reaches the red UFO at 140.17, we can see that at 140.17, the expected value for the put is 788. So this trade is a trade with $788 of risk, okay? And depending on your account and your risk appetite, you may be happy with it or you may not be. So if you're happy, you can execute. If you're not happy, practice it in a demo account, in a paper money account, so at least you get to learn from it. Okay, and if you're happy, just take the trade. Okay, and if you take the trade, two things may happen. It goes against you, and if it goes against you, the most you will lose is $788. Even though if it goes against you, maybe that red UFO failed, but this one works. So then it's gonna come back down, and then you're back in business, right? Now, a different story is, what if you reach this further UFO? What should you do? Well, then I would recommend, okay, to sell the put for a profit, okay, if AGN reaches the green UFO located at, and we are talking about here 123.44. Okay, so again, what if you do the 123.34? Well, if I add 123.44, 123.44. So if I add the 123.44, what it says here is that the option is likely to become 1,808. So in other words, if you're gonna sell the put for 1808 and you bought the put for 780, so how much can you profit in this trade? Well, you are likely to make $1,000 in this trade, okay, out of using $780 of your buying power, which that is a rate of return of 131% on the put. So basically, you're about to buy a put that is about to double its value if you reach the bottom UFO, which is likely because you're in a downtrend and you have sell-on field orders to push prices down. Okay. Now, some of you may say, what about this one? Well, I am respectfully ignoring this one because we're in a downtrend. So in a downtrend, normally buy orders are taken out. So these buy orders may be canceled, and this green UFO may work less efficiently. So now you tell me, okay, I'm going to take this trade with multiple puts. So what you could do is sell the put. Let's say you use two puts. So you buy two puts when it gets to the red UFO, right? So one thing you could do is that when you get to this green UFO, go ahead and sell half of your puts for half of the profit and leave half of the puts open until you reach the next UFO, if that's the case, and now you're gonna make your $1,000 per put. Okay. So anyway, my friends, this is the trade, this is the plan, and this is the time to conclude the session, guys. Okay, so it's been a pleasure to have you with us today. You've been quite quiet today with your questions. I was watching your comments and so on, and well, very appreciated. Some of your comments were very nice for me to read, but really none of your comments were questions. They were just comments and so on. So that makes me understand that you were kind of following the session. If that's the case, that's good. If that's not the case, and you were just quiet because this is a little new to you because you never traded options before, then please don't be shy. Just make sure you type your questions on the comments box the next time we're in the session, because remember, whatever you type, only me see it. So it may be a very basic question and it's okay. No one sees that question, only me. Then if the question is relevant and in order to provide an answer, it's healthier for me to get the question in the main screen, then I manually put the question on the main screen and then we talk about it. Okay, so you can be really open to comment on whatever you want to comment or ask whatever you need to ask to make sure that you get your questions answered, and those get-together sessions help you not only to find a few trades and execute and make some money, Of course, sometimes also take a few losses. It's part of trading, isn't it? But as we spend time together, we'll make profits together. So hopefully the sessions are helpful for that purpose. But beyond that, I want to make sure that you don't just follow it because I said. Which I don't think that's your intention, but just in case, I want you to make sure you understand that my intention is actually that you understand why. Okay, so if we plan a trade in a certain way, why is that? So you can replicate that yourself later on, and therefore it helps you to grow as a professional as well. Okay, so guys, again, pleasure. See you on Sunday, guys. Sunday, we're gonna be doing sharpening. We'll get deeper into option stuff and more. Okay, so looking forward to see you then. Until then, you guys take care. Have a good remaining part of the week. Tomorrow is Friday. For the non-directional traders, perfect day to do the non-directional trade. So you sell options and you let them decay over the weekend, which is 2 days of decay, exempt of market risk because the market does not move over the weekend. Okay, so pretty cool. Why not? You guys take care, plan your trades, send your questions if you have any. See you soon. See you on Sunday. Bye-bye.